stock market is booming, yet you're still ramen noodles for dinner. Confused? Well, you're not alone. A recent Bloomberg study found 64% of Americans live paycheck to paycheck. But another study by Gallup says 54% of Americans actually own stock. What's going on here? Is the financial advice machine broken? In today's video, we're going to untangle this mess and see why so many people seem stuck between stock ownership and instant noodles. Get ready, because things might get a little surprising. Many people feel stuck in a cycle of living paycheck to paycheck, lacking control over their finances and overall life. This is where saving comes in. It's a powerful tool that can empower you to take charge. Saving becomes a discipline. Just like any discipline, the act of consistently putting money aside fosters a sense of accomplishment. Even if the reason for saving isn't entirely clear at the beginning, the act itself can be a positive step forward. Take someone who starts saving regularly, even without a specific goal in mind. This consistent effort builds a safety net, a financial cushion. This financial cushion translates into power. Imagine a situation at work, a frustrating event that pushes someone to consider quitting on the spot. Without savings, this might feel like an impossible escape. However, having a financial buffer allows that person to walk away with confidence, knowing they have some time to find a new opportunity. This sense of freedom and control comes directly from having built a savings habit. The power of saving isn't just about leaving a bad job. It's about opening doors to new possibilities. Knowing there's a safety net allows someone to pursue their passions, whether it's starting a side hustle or taking a break to travel. The security of savings removes the dependence on a single paycheck, creating the space to explore different paths. This newfound power, a direct result of consistent saving, is something everyone deserves to experience. Now, many resources discuss emergency saving goals, typically recommending a safety net of 3 to 6 months of living expenses. This is important, but it's just one piece of the financial puzzle. Often overlooked is the significant role savings play in enhancing your daily life. Think of it this way: saving shouldn't be an either-or proposition when compared to investing. It's a powerful tool that can work alongside investments to create a well-rounded financial strategy. There's an important middle ground where a dedicated savings account can supercharge your financial well-being. Consider life's annual desires. Imagine your child begging to go to summer camp, or that dream vacation you keep putting off. Maybe you finally want to tackle those long-awaited home improvements. These shouldn't be funded by dipping into your emergency funds or resorting to credit card debt with its sky-high interest rates. This is where a separate life fund savings bucket comes in. This acts as a financial cushion specifically earmarked for these anticipated expenses. It is a way to prepay for those yearly occurrences: birthdays, anniversaries, car maintenance, or even music lessons for the kids. By consistently saving for these predictable events, you avoid the burden of debt and the associated high interest rates. Now, let's address the concern about inflation potentially eroding the value of your savings in the bank. It's true that bank interest rates may not fully counteract inflation, but the impact is minimal compared to the crippling effect of credit card debt. The high interest rates charged on credit cards far outweigh the slight decrease in purchasing power due to inflation. Here's an analogy. Imagine inflation is like a slow leak in your financial tire, as we always see. It gradually reduces your purchasing power. Credit card debt, on the other hand, is like a giant slash in that tire. It renders it completely unusable, and replacing it, paying off the debt, is a much more expensive proposition. Therefore, prioritize saving for these everyday needs. While inflation might cause a slight decrease in your saved money's value over time, it's a much wiser financial strategy than the crippling burden of credit card debt. The peace of mind and flexibility that comes from having a dedicated savings account for these predictable expenses is invaluable. It allows you to say yes to life's little and big pleasures without the stress of debt hanging over your head. While saving in a traditional bank account might not be ideal for long-term holdings due to inflation, it serves a crucial purpose. Think of it as a staging ground for your financial goals. Once you've built a comfortable emergency fund and a dedicated life fund for predictable expenses, then you can explore investment options for long-term wealth building. Let's say you've reached a point where your emergency fund covers 3 to 6 months of living expenses, and your life fund handles annual needs like vacations and car maintenance. Now it's time to explore investing for long-term goals like retirement or a child's education. Here are some investment options you might consider when the time comes. Retirement accounts. Contribute to a 401k if your employer offers one, taking advantage of any employer matching contributions. If not, open an individual retirement account, IRA. These accounts offer tax benefits on contributions and potentially on earnings, allowing your money to grow faster. Stocks. For long-term growth, consider buying stocks in established companies with a history of solid performance. This allows you to own a piece of the company and potentially benefit from its future success. However, remember, stocks can fluctuate in price, so diversification is key. Mutual funds. Invest in a mutual fund, which pools money from many investors to buy a variety of stocks, bonds, or other assets. This provides instant diversification and professional management, reducing risk compared to buying individual stocks. Index funds. These track a specific market index, like the S&P 500. They offer a low-cost way to gain exposure to a broad range of stocks and generally have lower fees compared to actively managed mutual funds. But the key is to prioritize saving over credit card debt. Many people, worried about inflation, fall into the trap of relying on credit cards to maintain their lifestyle. Remember, the high interest rates on credit card debt far outweigh the slight decrease in purchasing power caused by inflation. It's a much wiser strategy to manage inflation through saving than to drown in the quicksand of credit card debt. Now, let's address another common misconception. Saving alone won't make you rich. That's true, but it's the first step. Consider this. Millions of people making over $100,000 a year are still living paycheck to paycheck. This high income doesn't translate to wealth because they haven't prioritized saving. True wealth comes from having a financial cushion and the ability to live below your means, regardless of your income level. Saving allows you to build this safety net. Without it, even high earners are just one job loss away from financial vulnerability. The key to building wealth is to save consistently, allowing you to invest for the long term without needing to tap into those funds for emergencies or everyday expenses. Remember, saving is the foundation for future wealth and a critical step on the path to financial freedom. Now, let's discuss another advantage of having a solid savings plan: liquidity. This refers to having readily available cash. In times of economic turmoil, like recessions or market downturns, those with cash reserves are in a powerful position. They can act strategically instead of being forced into reactive decisions. Many people believe they always need to be fully invested in the market. However, a significant portion of investors are currently holding on to cash, waiting for the right opportunity. These savvy individuals understand that recessions present opportunities for those with cash. They can buy discounted assets, like houses or stocks, while others are panic selling. Imagine a recession hits. People without savings are forced to sell their investments in a frenzy, often at a loss. However, those with a cash cushion can act strategically. They can deploy their savings to buy these undervalued assets, potentially increasing their wealth significantly. Having a readily available cash reserve isn't necessarily the most popular strategy, but it can be incredibly powerful. If you have a well-defined plan for deploying this cash during economic downturns, it becomes a valuable tool for building wealth. In conclusion, hopefully these compelling reasons have convinced you of the importance of saving alongside investing. Saving isn't just about emergencies or everyday expenses. It empowers you, improves your quality of life, and helps you achieve your financial goals. By saving consistently, you avoid debt, become a more resilient investor, and ultimately pave the way for building long-term wealth. Remember, this video scratches the surface of saving strategies. If you'd like to learn how to dramatically increase your savings rate, check out the linked video for more valuable insights. Motivational money habits, building discipline and smart financial habits.